So the big question is this: how do investors like us who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer.
Hey guys, John Boone here with the podcast. Super excited. Today, something really awesome just happened a couple seconds ago, and it's something I've been working on for such a long time. And that is really believing in yourself and understanding that you've got it right, and having complete and total faith that you can whatever it is you're doing the right way. And this is something, and it might sound dumb at first, but it's super important. And I want to tell you guys how you can apply that to financial crises, and specifically I want to talk a little bit more about the '08 housing crash. I think that's a really cool thing to do. So hey, first things first, I was just walking out of this awesome trading floor. They had like giant computers everywhere. They had a full this history of the stock market. Oh my god, it was the most fun thing in the whole wide world. I made a video on it, so hopefully you guys see that on YouTube. Super exciting stuff. And we talked about how you don't have to actually understand all the history of the stock market to make a bunch of bank, which is awesome. I'm so excited for that to come out. So as I got back, I left the building, right, and I got back on my bike, and I remembered it was a little bit tough to get in. I had to find my wallet, get out my card, scan it, all that good stuff, right? And so when I got on my bike, I was a little bit worried. I was like, oh, I should probably check, make sure that I still have my wallet, kind of important stuff. And this is something, the wallet, it all comes down to having trust in complete and total uncompromising belief in yourself, right? So let me elaborate on that a little bit. A lot of the times, when I was starting this podcast, I would do it on my phone, right? And I would get worried that, if my phone wasn't recording, oh, that would be terrible. What would happen? And so I think I've done, 10, 20 episodes by now. I'm not 100% sure. That sounds about right. And every time every time I was doing it, I would always be worried, and I would check my phone, and I would say, oh, I got to make sure it's recording. And in the all the things I've done right now, there's been a sum total of one time where it didn't record. And it didn't record, I think it was in my bag in a weird spot or something. And it was this weird one-off thing. And it made me realize, for all the energy and all the effort and all the frustration that I'm putting on thinking about what this worst-case scenario could be, I was on my bike, and I would stop, I'd put everything down, and then I would go and look, take off my backpack, open up the flap, open up all the flaps on the back, go and get my phone, and then it would say it was recording. I was like, oh, great, it's recording. I can just, put all the stuff back and undo everything I just did. And it made me realize that for a ton of what I do, it's you just have to trust yourself and believe that it's done, because it would always be done, right? It was never not done. But it was always that skepticism, that fear of oh, well, what would happen? And at a certain extent, you have to let go of that fear to completely free yourself from the bounds of your own, mind, right? So for me, the problem was my own self-doubt. And that self-doubt, it just recently manifested when I, because what I always do, right? I always put my wallet away. I always put my phone away. Always very careful. And it's very important, it's definitely cool to double check that stuff. But you have to have that faith in yourself, right? So if I do the same thing, every single time, and I remember, and I say, look, this is how it works, this is how it happens. And then I'm like, oh, why isn't my wallet in my pocket? Well, it's because I put it in my bag. And then I think, okay, well, was there anywhere I stopped today where I might have put my wallet down in the past 10 or 20 minutes? No, right? So no risk, no avoidance, and yet there's still that nagging fear of, well, hey, how do I know that I'm not messing up here? How do I know that in reality, maybe I did put it down somewhere, or I left it somewhere, and maybe I with the phone, right? So maybe it's not recording. Maybe I didn't push record, even though I know in my heart, I know in my gut, I know that it's done, right? It's not a matter of questioning me. It's guaranteed. It definitely happened. But to that self-fear, self-doubt, all of a sudden, I stop everything I'm doing, and I think I get everything out, and I will just mess it up. It's a bad problem because it's done, it happened, but you're double checking, and that double checking is a really big problem. Now, it's not to say to be ignorant and dumb, right? So, for example, the other day, I fell on my bike. It kind of freaking sucked. Forgot my helmet. I realized I forgot my helmet like probably 8 seconds before I fell off my bike. What I should have done was like immediately stop and turn around and get a helmet because I was dumb and forgot it. But I didn't, and I fell. That kind of freaking hurt. Now, similarly, I just realized like 2 seconds ago that I totally forgot to take my gloves out of here and put my gloves on. So what I'm doing is I'm stopping and putting my bike down, not to check something, because, yeah, you can check if you're doing it anyway, but like not to check or be worried about something, but because I legitimately realized, hey, there's no gloves on my hands, so I should probably stop and put gloves on my hands. Because who knows, right? Maybe if I kept going, the next turn I took, I don't know, you got to be safe with it, right? So, with things that have immediate impact, right? Like, yeah, you have to take control. You have to, stop, put it down, take a break, and understand the positioning that you're in, and use that positioning, as a way to, shift your direction and create the better path that you want to be on. Because that's really important, right? It's important to have gloves because I learned when I fell that it hurts to not have gloves. So, yeah, right? You learn through experience, you learn through whatever it is that you do. But it's super, super... Ooh, can I make it here? I wonder if I can go across. I can go across? All right, cool. It's super important to have that understanding of yourself, to have that understanding of whatever it is that you're doing, so that when it comes to that point where you're thinking, oh crap, did I do this? You ignore it. But when it comes to a point where you say, oh crap, this is a serious issue, that's when you take control. So that's what I want to talk. I want to apply that to financial markets, right? So this morning, something really, really, there's a Tesla, that's so cool. Something really interesting happened, right, with Amazon stock, right? So, I don't trade pre-market. Pre-market is super, super sketch. It's really a tough game to play. But Pam was doing her trade, and she put in some shares in Amazon in pre-market, right? So she bought pre-market, and it was probably like 9.15, which was super cool. And she got filled. Prices were done. And yesterday there was a huge run up, as I talked about in the other podcast. And when that happens, there's that innate like recoil of, oh, I made a couple grand or for a couple small percentage points or whatever. There's that urge to pull out, and there's that urge to double check yourself, right? So just like when I would double check my stuff was in my my backpack, that's the same as saying, oh, well, maybe I should get out really, really quickly because there's this quick profit, which totally, it makes sense. Like if my gloves are off, that's when I would check my bag, right? But if it's just a nagging fear, that's usually not the time to make those immediate decisions. Those immediate decisions can have a huge impact, right? So for this trade, hey, on your right, thank you. The stock, opens, and then it breaks to the VWAP like immediately at 9:30, which is awesome. Super, super bullish indicator. And I don't know exactly how the trade went down, but she sold out pretty early because there was that nagging fear of like, oh, what could happen, right? Which sucks. Ooh, it really sucks. And it went up, pretty freaking sizable amount. It was, I think, 19.44 to like 2K, which was, percentage-wise, not that much, but like I said, big position size, that makes a big difference. So that's, really, that's, 25, 10%, something like that. Maybe not. Math could be off. Probably is off. But it was a big move. So I want to think like in crashes, right? In the crash of 2008, housing market crash, I mean, stuff got super, super bad. And especially if you're indices, people lost, half their portfolios over the course of a couple months, which sucked. I mean, that's really, really bad. But then if you look at individual stocks, they were going down 90+%. It was crazy. And the part with it was waiting, right? So right now, I'm at a street and there's some cars going across really, really quickly. And I have to sit here and just wait. And it's, my time, but, whatever, right? It's going by, and I'm just waiting. I'm losing, the time value of, I could be biking home right now, but I'm having that safety, right? And you have to understand that, if you're sitting on your bike, you have to wait for the cars to cross the street, and then once the light turns red or there's a shift, right? Once there's that shift, then you can go and you can bike as much as you want, you can do whatever you want, because there was that change in market sentiment. So that same ideology applies to financial markets, right? So there's a shift in overall index funds, right? And they go down 50%, which is terrible. That's why you have, that's why I'll talk about diversification in just a second, but that's why it's so important to have solid diversification in non-correlated assets as you are retiring, because people that were retiring in 2008, that was not a good time. But it was okay as long as you had that diversification towards your retirement goal, not necessarily at the beginning. But we'll get into that in a second. That's more like chapter 35 of the book. So anyway, you have to wait for the street to clear out, and then you can cross the street, you can do whatever you want. That same mentality applies into these index crashes, right? So you'll have these indexes, and in the long term, oh gosh, ouch! In the long term, they go up 9% a year for the S&P 500, probably 11 or 12 for the Nasdaq, and then after inflation, it's 2%, so 7% conservative average annual stock market return, which is a solid number. Really, really cool stuff. And you can use that number, to compound your wealth long term and to, build real savings and retirements. All that awesome, fun stuff, which is super, super cool. But in the short term, right, in the medium term, there are definitely these big crashes. So you'll see, the stocks, they go, and if they go, they'll go, right? So it went down 50% in a year, 2 years. I mean, that was huge. That was, years and years of growth wiped out in index funds. And the really powerful thing is you can, hey, thanks man, I really appreciate it. You can dollar cost average, right? So if you were, getting in over a longer period of time, you would have average prices at the high points, average prices at the low points, and then you would have, a better overall portfolio of growth. Your prices, you're not just at the highs, you also buy at the lows, which is super powerful. But the other thing with it, right, was it was just like crossing the street. You just had to wait a second. So when I was waiting at that stoplight, I had the luxury of time. And that time gave me the insanely valuable ability to just sit there and wait, right? And that's what people, should do and in crisis. You just have to let it play out, let it go to a spot. Because look, timing a market is virtually impossible. It's very, very difficult. Unless, if there's a super big, so with the real estate crash, people could understand why there was going to be a real estate crash because of the underlying problems that were happening with the real estate markets through all the. I feel like it was collections of uncollateralized loans, which were just these really, really, really low quality collections of loans. They're being sold to people as CDOs, which are just big collections of ridiculously low quality, home mortgages. And then you would have companies that would actually go out and they would act as a third-party underwriter for asset investments in these very, very, very risky securities. And they would leverage themselves 100x multiples of the amount of capital they would have and say, hey, if you lose your money, we'll insure you for all this money that we totally have, but then they actually didn't have that money. So it was a big problem. So the reason that it happened was because if you're a fund, usually there's some restrictions, especially if you're operating in the public space on what you can invest in, right? So for instance, there were some state funds, and if they wanted to buy these newer, riskier investments that were collections of low-quality home insurance mortgages, home mortgages, if they wanted to buy these home mortgages, then what they could do is buy a huge basket of them, so it was diversified, so it wasn't all the risk on one single position, and that was really powerful for them because it allowed them to have these very, very high returns since they were paying high interest rates. High interest rates equals, more profit for the people lending out the money because they're incurring a greater risk to lend out that money. and then a higher average return in a diversified portfolio where you have a very big collection of, mortgages. So if you have like 100 mortgages, if you want to go bad, you're still going to have an overall growth. And that works until it doesn't work, right? So these guys were out there. This is really, really awesome movie about the 2008 crash. It was called The Big Short. Big Short. I can't recommend it enough. Amazing movie. Like, Big Short and The Wolf of Wall Street. I mean, Wolf of Wall Street, it's kind of, but those are really cool, like finance movies. And what happened is there are these massive problems in the industry based on this debt that, like, seriously, it was out of control. And because of that, these financial instruments, they were not going to hold up, right? And they didn't. So what happened is you would have these big funds, and they would buy these very, very securities, and then they would have them insured. So securities would be like double B credit ratings by these centralized agencies. They can show the risk profile is mostly in the bond market, and you can use it to justify the addition of a position in a portfolio, especially when you're managing public funds, right? So if you have hedge funds with millions and millions, billions of dollars, they can justify a triple C or a very, very low quality investment if it gets insured, quote unquote, by an underwriting company, and then they would have like AAA, they would be the best, or they'd have A plus a credit rating, and that credit rating would allow the investment to be in the fund, even though the actual underlying investment that was insured was way out of the fund's investment means, right? It was totally inappropriate for the purpose of the fund. It was totally inappropriate for the people, because these people are managing tons and tons of cash for just average normal people that put their money in like a state trust or some sort of normal investment fund where they're expecting these normal returns, and the normal returns that are associated with the risk that is given by the underwriter. And it's totally, it all works out. You pay like a 1%. It's like insurance, right? So if you pay, maybe it's like $100 million position, you would pay like $1 million to this underwriter. Oh, and then after you pay them, they would say, okay, we guarantee you the value of your position, or something like that. If it goes down, or if it crashes or something, which was in the long term. Which was super, super powerful because it allowed them to have these very assets. And it worked, right? So what happens, you have all these people pouring millions, so much money into these financial assets that were extremely risky. Right? So what happened is the bank just ran out of stuff to sell, and then they issued a ton of crap mortgages and used those as a way to create these new CDOs, these new collections of home mortgages. And there are a lot of fancy words and a lot of really thin-tabbed language, but the point with it is that these guys took the housing market too far. They took what was traditionally a solid asset and a means to invest in the long term, and they turned it into this speculative game, and too many people got in it, right? And when too many people got in it, they had to find more stuff to sell. So they found more stuff to sell by trapping more Americans. In Big Short, the movie, they have a very, very specific case study where this woman had like 4 mansions, and it was like, whoa, right? Because she was not in a financial position to have that, but the bank gave her all these loans and just let her do it. And the reason that happened to so many people, it was because this housing, the prices, right? They were inflating. There was just so much. It was this huge bubble of demand, and a lot of people that were in the space, they realized, wow, these houses are priced ridiculously high, and the people were buying them, right? So people were speculating, they're investing, and because of that, this bubble emerged where the prices were too high, and the banks were allowing that with this very easy to access debt, and also they were creating these significantly more complicated underlying assets that you could buy and use as a means to invest in a very, very unproven and essentially just, it was like the bottom of the bottom, right? You had the quality of bonds went from top to bottom, like A to like triple C, and then they would disguise the triple C's as like A's or B's. You were at the bottom of the scale on investment quality when you got to these very, very low tier collections of collateralized mortgages. So in a very, very short sense, what happened was one company fails, or one thing collapses, and now you have these insurance companies. The insurance companies have leveraged themselves. They're insuring like $100 for every dollar they have. They have no means possible to pay for a crisis if it happens. In fact, if 1% of their clientele needed to actually leverage their utility, they would be completely screwed. And that's what happened. You know, people went out of business. One thing went out of business, and all of a sudden, you know, prices were too high. People weren't able to support the insane growth. And in a very short sense, you know, this housing market came toppling down as these insurances, they weren't able to pay, right? So because they weren't able to pay, they went out of business. And all of a sudden, this asset that was rated AAA because it was, or rated AA or whatever, because it was protected by the underlying insurance. If that insurance company goes bankrupt, now you have hundreds and hundreds of trusts that own an underlying piece of real estate investment, an underlying fund, or an underlying collection of home mortgages. And that collection of mortgages was originally extremely dangerous, but it was proven safe because of the insurance. But once that insurance goes away, the credit rating decreases. And when the credit rating decreases, now they have to sell it because they aren't allowed to hold that risk profile in their portfolio. So these major funds had to toss, you know, hundreds of millions, billions of dollars out the window and sell their positions no matter where they were. And then you had this mass panic to get out, right? Everyone was getting out. And that caused this massive selling pressure. And as you guys know, I mean, stocks move because of buying and selling volume and public perception, and that affects buying and selling volume. So if a bajillion people try to sell at the same time, these things crash ridiculously quickly. And then it spurred the next series of failures, right? So more and more of these funds would have to drop tons of money out of their investments because they just weren't able to, you know, handle that risk. Hey, thanks, man. You're the best. Ugh. They weren't able to handle that risk profile in their portfolio, and they had to sell. So more people sell, more the insurance companies go out of business. It's this chain effect. I mean, there were a ton of things behind it, but that was a really big part in the financial space where people were they were getting screwed left and right because one thing led to another, and failure after failure. Hey, thanks, guys. And they were just done. And then more and more happened. Lehman Brothers fell, and it was all because these terribly speculative securities that were created based around home mortgages, which is really crazy stuff. Now, it's not always easy, right, to predict a market crash, especially looking exclusively at index prices. You know, it's really, you can't really like predict what the top is, you know, or the bottom for that matter, right? Like, it's not like the bottom of the crash of 2008, which was like a huge financial crisis. It's not like that bottom correlated to, you know, any certain issue in the industry. And it's also not to say that everyone was doing terribly at the time, right? You had firms outside of the housing space that weren't involved in the bubble, that weren't involved in all that crap. And those firms were crushing it. There were a lot of people doing really well, but there were also a lot of people that made some major mistakes. Like, you know, if you're losing money, you don't fire salespeople, right? Salespeople are the bread makers for a company. They bring in cash. And you had a lot of really big players, and they were firing their sales staff. And because of that, the revenue was just plummeting. It was really bad. It was a huge problem, just because they mismanaged the people they were working with, and that caused just a massive change in the industry because people were seriously messed up. And so it was a really big learning experience, also a really big growth experience. One of the best times to buy stocks, I mean, is like, you know, when that happens, but you really just don't know when it's going to happen. Hey, thanks, guys. So you just kind of have to work through it and get going. So going back to that example, right, of me standing in front of the road, like what was happening in that financial crisis, I mean, it was pretty apparent, but it wasn't apparent at first, right? Like the stock market has a huge top, but no one really knows like what's going to happen next until like news comes out of like all these scandals and all these super big issues. But even then, it's ridiculously difficult time. On your left, all right, hey, thanks guys, you're the best. I really appreciate it. Thanks. You know, with that market, right? You can read the news, you can watch the news, you can do whatever the heck you want. But it's ridiculously tough to like actually figure out, you know, what's going on here, what's top, what's the bottom. People that did it, they did it very well because they understood the underlying problems, right? They were in the housing market and they made it work. they saw the problems. That was what The Big Short was about. Really, really great movie. Because in The Big Short, like they understood it and they were in the zone. But a lot of people, they weren't. A lot of people, they felt a lot of pain because those portfolios, they went down really, really quickly. Just like standing in front of that street, they couldn't really like cross the street to say, right? So that maybe for them that would be they couldn't sell their positions because their street, the cars go by really, really quickly. Maybe in the market, similarly, you have all these assets that are decreasing at such a rapid rate that it just doesn't make sense to sell and take that loss. That loss is super, super bad, especially if you're used to standard stock index rates. So what you have to do is you have to sit in it for the long term. You have to sit in it and just let it work out. And when you do that, something really, really interesting happens because after the bottom, right, stock market has the best run up it's had like ever, longest bull run in history is occurring as we speak, and it goes straight past the highs, doubles, triples, whatever, and that always happens through time, right? It's that long-term compounding growth that you're playing, and sometimes you have to step back and say, hey, I guess this is just what it's going to be for right now. I'm just going to leave it and let it do its thing, because that's money that you put away for a very, very far away future date, right? Because you understand that this is an investment in yourself, it's an investment in the American economy. It's an asset. It's going to compound in value. It's going to compound in growth over time. And especially if you're just like hands off, not worrying about it, like with an index investment, that's something where, I think I saw the statistic and it was like average market return is 9%, right? So that's like 7% after inflation. Hey, thanks. And this is it talked about people that try to time the market, especially with like long-term retirement funds, maybe not necessarily using technical analysis to really get a grasp on their positions. Hey man, thanks. Good luck. They weren't really using technical analysis. It was just based on emotions and media and news and like what people were saying was going to happen, which is just never a good principle to invest on. Is other people's opinions, because usually the media, the masses, they're pretty much wrong. It sucks, but that's sort of how it works. So as you take control of your portfolio, you sort of have to stand back sometimes and say, look, the statistic I'm talking about, it was looking at the actual market return of people that were investing in index funds. So like the human return, and they call it human error. And what it was is people were buying and selling based on emotions, based on the media, based on all these factors, because they thought, oh, the market's going to crash, the world's going to end, I have to sell my portfolio. And the average return for an individual investor, careful, in the study was 5%, just investing in index funds, which are historically 9%, 7% after inflation. So they were losing in the market 2-3 percentage points, give or take, in this study, purely because they try to time their investments, they try to time the market, which is a serious no-no. I mean, it's so difficult to time, large index funds. Now, not individual stocks. Individual stocks are a totally different game. You can use the amazing power of technical analysis to understand the price movement of individual stocks. I mean, it's insanely great what you can do on that side. But with these overarching index funds, you just kind of have to stand back sometimes and say, look, this is a fear. It's in my head. Whoa. It's a fear, and it could definitely, bad stuff could come from it. Just like, I know, like if I'm worried about stuff in my bag, like I'm worried that my portfolio could like go in half in the next 6 months or the next, couple of years. Like, yeah, like that's a legitimate concern. That's a serious problem. But at the same time, it's not like I'm not going to go to school, right? Or I'm not going to ride my bike, or I'm not going to record this podcast. You still have to be there. You still have to do it. And you still have to commit yourself, right? So in the financial market, if you're worried that your portfolio is going to go down because of a crash, like that's a legitimate concern, it's a valid concern, but you also have to understand that you're in it, for so long. And it's ridiculously important to understand that, so that what you do doesn't get taken as just a leap of faith or a singularity. It's all about that important, especially if all you're doing is index funds, it's that long-term mentality where you can step back and say, look, you know what? There was a problem. It was a bad year. And there are bad years, right? It's not only green. There are definitely red years. There's risk, and it makes sense. That's how markets work. That's how they reward you over time, right? It's all about, understanding that there's that long-term risk. I talk about in Chapter 35. This is an awesome chart, and it shows the individual volatility of the stock market and the average percent returns of the stock market the look back period for a certain number of years. That shows the maximum up and the maximum down for any given look back period from the current day to like 1900 or something. It's all in the book, but the really cool thing was they looked at the entire historical performance of the market and they said, hey, look, every time there was a 1 year change versus a 2 year change, 3 year change, 5 year change, 10 year change, 15 year, 30 year, 40, 50 year change. In index funds, here was the maximum and minimum return. And I think it was in the chapter. It was in the chapter about bonds because it was comparing that to bond returns over time. And it was showing the volatility of a given investment based on the time, right? So more years in the market means more stability, means an incredibly higher likelihood of a long-term gain, especially with these index investments. And a lot of the time, you just have to pit your instinct, or well, it's not necessarily instinct, but like you're that nagging fear in your head of, oh, it could happen. You just kind of have to put that away for a second and understand that what you're investing in is so powerful, and you use that as an understanding that, like, yes, I understand. I've invested in myself and my education. I understand the quality of what I'm doing, and I will use that to make these informed decisions in the market rather than rash stuff like that. Because you don't want to get screwed on a position that goes sideways or a short-term pullback. Because it's super important to understand the actual potential of a position, right? Like the market only goes up in long term. Right? In the long term, it's just recovers from the crisis. The economy grows, and people profit, and it's awesome. It's a great system. It's tremendous. But with that, there are those short-term pullbacks where you just have to sit back. You have to say, look, this sucks, really sucks. But that position in Amazon today sold out quickly after the market opened, and then it proceeds to go up a whole bunch. Like, miss out on a lot of that gain, which sucks. But sometimes you can't chase stuff. If a day trade specifically, it's very risky to try to chase the stock. It's just not a good thing to do. So a lot of the time, you just have to understand that there are trades where I will see it and it'll break through the view app, or it'll break through the D and an ABCD setup, and maybe it does it really quickly, and I was just too slow. On your right, hey, thanks so much. And I was just too slow. And if you're too slow, a lot of the time it comes down to not having enough monitors. It comes down to not having enough charts, right? So if you can open up like 8 charts and have buy buttons on all 8 charts, you're going to be at an insanely incredible advantage in the marketplace, because you'll be able to react to more stocks quicker. And then when that winning position comes up, you have a much greater chance of having it on your screeners and seeing it break out, being able to push buy. And that also comes down to having that handheld calculator. Having your handheld calculator, you can immediately calculate the amount of shares that you should buy based on your average intended position size for the given stock's price, which will vary based on whatever equity you trade, which is super important. Speeding up that process, speeding up that order entry, because like deal with this, right? Yesterday we missed it just because we didn't have the order entry fast enough, and sometimes you have to use a market order to get it fast enough. Sometimes you don't. You still need to calculate. You still need to push the button. You still need to have the chart up, and it's just speed is really important for that. So when you use speed, you're able to rapidly increase, right? It's like coming at that street, and there's like 5 seconds left on the crosswalk, and you have to understand that like either you're gonna make it or you're not, and you can put on the throttle, you can put down the gas, you can pedal to the metal, or whatever, and go hard and rush through the ending and get it in on time, right? And by that I mean like have your order ready, have your order done, have your order submitted, and get it in on time, get it in before that crosswalk stops. And if you do, great, you're going to reap the rewards, you're going to get across the street, you're not going to have to wait for the cars, you're going to be great, you're going to do tremendously. And that's when you get in the positions quickly. But at the same time, there's the risk of like, okay, well, I don't want to get hit by a car, so I have to make sure there's actually enough time on that street, on the crosswalk to do it. So in the market, you can extend that mentality by saying you have to make sure there's actually enough, price range, enough volume, enough trading. It just all comes down to technical analysis. Make sure it's the right setup, because you can, at the same time, you can slow down, you can lay off the gas, you can chill out, and you can just say, hey, look, you know what? I'm going to go as hard as I can, but if I don't get in the trade, don't get in the trade. And once that once that crosswalk goes from walk to stop, then you have to stop and you just have to wait. You just have to wait for all those cars to pass, wait a couple minutes, and just deal with it. It's just a couple minutes. That same principle is true in the market, right? You'll have positions and they will look amazing. They'll be perfect, but then they'll break through that one critical price level before you could get in. And it's just that red stop sign. You just have to stop. You have to put up your hands and say, look, you know what? On to the next trade. I'll see if I can get in later. Maybe if it's a really big run-up, it'll turn into an ABCD setup later, which has happened on multiple occasions, right? I was trying to get in. I didn't get in on time, broke through the VWAP, had an amazing run-up, and then it actually turned into the A in the ABCD setup, and I was able to trade that, which was awesome. Great gains later. Not a big deal. You can always come back to it, but you can't really, you can't chase it, right? You can't start crossing the road when cars are coming at 100 miles an hour. And yes, there is that chance, right? There is that very small chance that you can trade it after it's broken out, after all the amazing things have happened, and you'll get lucky and it'll keep going up. Just like you can, you can try to cross the street when you're not supposed to, when there are cars coming, 40 miles an hour, but you see a gap in the cars. Like if you game it right, once in a couple of times, like you can definitely make it through that intersection, make it through the crosswalk, A-okay, it'll be cool. But there's also that chance that, like, dude, you could get hit by a car. And that extends into the market with the mentality of, you can definitely get in after a solid indicator, after the original trade entry should have been. But if you're chasing it and that thing reverses, you're not going to have that same price entry point. You're going to have a significantly easier downside, right? So if it reverses quickly, you'll be out of the money before a lot of people that were originally in the trade based on the technical setup. And that's a serious problem because it puts you at an extended level of risk. So you have to wait or risk it. But when you risk it and that stoplight turn and that indicator is shown, a lot of the times it sucks. And I felt it, man. I felt it so many times when there was this amazing setup and I just missed it. And you just kind of have to sit back, stand up at the intersection, stand up at the stoplight and say, look, you know what? I'm going to live with it. I'm going to make it work. It's not a big deal. I understand that this is just something that happens. It's just something that happens when you trade. You'll miss positions. It's okay. You don't have to chase them. Sometimes you can. Sometimes you can't. You just have to understand that you can't win everything, but you can definitely get in there. But if you don't get in there, totally cool. Just got to chill back, walk out, and understand that you're in it for the next one. You'll wait for that light to change. You'll wait for the next stock because there's always another stock. There's always another opportunity. There's always another position in the marketplace. The stock market is insane. It will change your life. It's a world of opportunity. And there's another stock out there. So, hey, hope you guys enjoyed this. Hope you guys get out there, trade, crush it, have an amazing day, and got a ton of value out of this. Super cool stuff, guys. Have an awesome day. I'll see you later. Thanks.
Want more stock market secrets? If so, you'll get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover, completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.